Margins don't just move, they speak. The real question is, are you listening?
Welcome to another deep dive with me, Thanya, your international finance and commercial strategist. Today, we're decoding one of the most misunderstood charts in finance, the margin waterfall. You've seen profits rise and fall, but have you ever stopped to ask why? This 5-minute session will help you understand each margin driver in detail: price, cost, mix, FX, and volume. Read a waterfall chart like a strategist, and most importantly, translate numbers into decisions. Margins don't move by chance. Every fluctuation tells a story, one that can either protect or destroy value. When you see gross profit drop from 22% to 18%, that's not just a financial outcome, it's a signal. But without decomposition, the story stays hidden. And that's why the margin waterfall is so powerful. It shows exactly what moved your margin and by how much. Think of the margin waterfall as a step-by-step journey from your previous period margin to your current margin. Each bar in this chart represents a factor that either increased or decreased profit. Price effect: did we sell at a higher or lower price? Cost effect: did costs rise or fall? Mix effect: did our sales composition shift? FX effect: did currency rates play a role? By visualizing these steps, you can literally see what moved your margin.
Every number hides a reason. The smart ones find it before quarter end.
Let's go deeper into each factor, starting with price, the most visible but also the most strategic lever. Price is your most direct driver of profit. When prices rise and volumes stay stable, margin improves. But if discounts, promotions, or negotiations reduce effective selling prices, margin can erode fast. Formula: current price, previous price, times current volume. This isolates how well your team captured market value. Even a 1% price improvement can deliver a double-digit boost in operating income. Imagine we sold 1 million units. A $1 increase in unit price means an extra $1 million in gross profit without producing anything more. That's the power of pricing precision.
Price doesn't follow the market, it defines it.
Strong pricing can't save a company drowning in cost escalation. From raw materials to logistics and labor, every cent counts. Formula: previous unit cost, current unit cost, times current volume. If your costs rise, the waterfall bar goes negative. But if efficiency improves, it goes positive, showing how internal performance shields your margin from inflation. Visualize cost per unit rising from $60 to $65. At 1 million units, that's a $5 million hit to gross profit, a big dent that can outweigh pricing wins.
You can't control the market price, but you can control your efficiency.
Volume changes amplify everything. When you sell more units at the same margin, profit grows proportionally. But when sales shrink, fixed costs bite harder. Formula: current volume, previous volume, times previous margin per unit. Imagine last year's sales were 1 million units at $40 margin per unit. This year, you sold 800,000, that's a 20% drop. Even without price or cost change, your profit falls by $8 million purely due to volume.
Volume is a megaphone. It amplifies every mistake or success.
Mix is often the silent killer of margin. It's not about how much you sell, but what you sell. If your sales shift from high-margin premium items to low-margin basic ones, total profit falls even if total revenue stays the same. Formula: total margin change, price, cost, volume, FX. Imagine product A gives 30% margin, product B only 10%. If product A sales fall 10% and B rises 10%, overall revenue looks fine, but margin collapses. The waterfall's mix bar visually shows that hidden drag.
If you don't track FX impact, your profit may be real only on paper.
The FX effect is like gravity, invisible, but always present. When your revenue is in dollars and your costs in euros or baht, currency moves can shift your profit overnight. Formula: margin at constant FX, margin at actual FX. Suppose the Thai baht weakens against USD. Your foreign revenue converts higher, but local costs stay the same. Margin looks better on paper. Reverse that movement, and margin evaporates instantly.
If you don't track FX impact, your profit may be real only on paper.
Animated table transitions into a bold waterfall chart. Each bar lights up as the driver is mentioned. Margins don't just move, they tell a story. Price gave us plus 80 BPS, thanks to premium positioning. But rising raw material costs hit hard at minus 150 BPS. Mix shifted toward lower margin products, dragging minus 180 BPS. FX added another minus 70 BPS as local currency weakened. Net result, margin compressed 320 BPS, sliding from 22% to 18%. Chart zooms out, highlighting the net drop. Overlay text, decision intelligence, focus on cost plus mix. This visual tells a complete story. Price was a win, but cost, mix, and FX pulled the other way. Management now knows where to focus, mitigate cost, and rebalance product mix.
A single chart can turn confusion into clarity if you know how to read it.
The margin waterfall isn't just analytics, it's decision intelligence. If price drives the loss, revisit discount discipline. If cost drives it, improve procurement or production efficiency. If mix drives it, adjust incentives and portfolio. If FX drives it, build a hedge or realign pricing.
Insight isn't the goal. Action is.
Margins tell the truth, but only to those who know how to read them. The margin waterfall gives you that language. So next time your CFO asks, "Why did our profit move?" don't just say because sales changed. Show the chart, tell the story, and lead with insight.
If this helped you see margin differently, subscribe and join me, Thanya, where finance becomes strategy.